Accounting and cost involved in Six Sigma Green Belt. So, what is the definition of cost? The amount that has to be paid or given up in order to get something done. So, in business, usually it is a monetary valuation. You put up a sum of money in terms of monetary value towards either effort, which took for the things to be done, materials required for production or service to be given, the resources utilized in the process of production, the time and utilities consumed to get things done, the risk which was incurred during the productions and service, and the opportunity cost which were foregone in the production and delivery of a good service. So when you pay or give up something in order to satisfy all these effort, material, resources, etc., that is called as the cost. That is the definition of the cost. So there are three different types of cost. One is accounting cost, economic cost, and opportunity cost. We will see each one of these in detail. First, what is accounting cost? Accounting cost are the actual or the outlay costs that point out the amount of expenditure that has already been incurred on a particular process and not on or on production, as such as accounting cost facilitate for managing the taxation need and profitability of the firm. So what it means is that it is the cost or the monetary value which has already incurred in the company in order to produce something or in creation of a service. Okay, it has incurred, but you are not including the profit markup here. Okay, to produce, for example, to give patient a vaccine, one vaccine was given to a patient. So what all cost had been incurred to get the vaccine, to place an order for a vaccine, to pay the nurse, to give a facility where the patient can come, sit, have a vaccine, take enough rest, and then leave. The consultation charges, etc. So these are the cost which came by just by giving the vaccine, but you are not calculating what the patient has paid you to get this vaccine. The profit has not been calculated yet. Profit we exclude in accounting cost. Accounting cost is just the cost which was incurred by the company or the institution while producing something or giving a service. What all cost they have to incur. So that is accounting cost. So different types of cost: direct, indirect, fixed, and variable. So in direct cost, it is the cost directly related to producing a good or service. Okay, for example, you are going to produce a papad. Okay, so what all direct cost is required? Purchase of the lentils or dals, which will purchase of the spices. Okay, hiring people, giving them hiring of group of women entrepreneurs to produce papad. Okay, where you will store, okay, warehouse to store the produced papad, how you are going to transport it to the consumers or shops. Okay, so these are the direct cost incurred. Indirect cost is renting a stall. Okay, you're renting some machinery which will give papad its round shape and all. Okay, you do not have your own institution to produce it. You have to get some machineries to produce it. Okay, rent, electricity used. Okay, that those all things are indirect cost. In fixed cost, it is the advertisement. Okay, it is fixed. The insurance of which you pay for your machineries, or for the health insurance or ESI, what are you paying for your staff. Okay, deposit amount for the warehouse. Okay, so these all comes under the fixed cost. Variable cost is depending upon the sales. Okay, this month you had the sales of 100 packets of papad. So next month you will prepare yourself for 150, aiming for 150. The other next month you have crossed 150. The next month, the very next month you will target for 200. So it is varying every month. Your sales is varying accordingly. The resources which you have to get in to make that increased sales possible every coming month. Okay, so it's a varying cost. Okay, so that comes under the variable cost. Tax, This year the tax may be more. If you are doing some social corporate responsibility, your tax will be less. Labor charges will depend upon the economic situation. Inflation will affect the sales and etc. And other miscellaneous expenses. So those are the variable cost. Then we have operating cost. Operating cost means the day-to-day operations that take place in the industry, that comes into operating cost. For example, daily water supply, maybe that comes under the operating cost. Office supplies, administrative supplies, pen, pencil, book, paper, registers. Okay, on daily basis you use this. Telephone and internet expenses, on daily basis you use this. Okay, the making sure that transportation is available for your employees if you are providing an in-house transportation, etc. Okay, so those are the operating costs. Day-to-day operations will require some cost. Okay, like petty cash, everything. Okay, those will come under the operating cost. And economic cost. Economic cost includes both accounting cost and opportunity cost. And economic cost, profit comes into play. For example, in hospital scenario, if a patient is getting hospital acquired infection while being admitted in a hospital, so it has increased the economic cost of the hospital, because now the length of patient stay will increase. And we all know that when a patient is admitted, the first few days of the admission, the first 2 to 3 days of admission is the profit period for one given admission. If a patient has a length of stay, increased length of stay, that profit line will go down as the length of stay increases. So that's an economic cost that the hospital has incurred because of a hospital acquired infection or a surgical site infection, any given infection. So it includes opportunity cost also, and economic costs are related to the future. So and based on this economic cost, decisions are made, because if a hospital infection, acquired infection took place, based on that decision will be made so that this will not repeat. Because it repeats, the hospital will be under loss, because the profit period will be very less, and the loss period will be more as compared to the profit period. So that's an economic cost. Then we have opportunity cost. It is what we have sacrificed divided by what we get is equal to opportunity cost. It's the cost of the opportunity which we are letting go. For example, um, you are going to start a clinic for uh, mother and a maternity clinic. Okay, but you are not going to give, because of a constraint on your investment, you are not able to give pediatric services. You can only hire an obstetrician. Okay, so you have to let go the opportunity of having a pediatrician. So the cost of letting go the pediatrician, and the profit which you could have got if you had pediatrician in the first place. So the profit which you're letting go is the cost of letting going a pediatrician. Okay, so that's an opportunity cost. But you are already a maternity clinic, so it is ideal to have obstetricians and gynecologists in your clinic. Instead of having you have a choice of hiring a gynecologist, you have a choice of hiring a pediatrician. The best possible outcome for your clinic is to hire a gynecologist. So you're letting go the hire of pediatrician. So the cost incurred to letting go of the choice of having a pediatrician is called the opportunity cost, because pediatrician could have brought some amount of profit into the clinic, but because of constrained resources, you can't hire both. You have to let go one. So that is called an opportunity cost. Return of investment. Return of investment means net profit divided by the cost of investment into 100. So that's the formula used in return of investment. It's simple, like normal profit means revenue minus expenses. So that's a normal profit. So that's a net profit here. And it is used to evaluate the efficiency of an investment and to compare the efficiency of a number of different investment. So when do you use return of investment formula? You have bought two capital machineries in your hospital. You bought a CT machine, you bought an MRI machine. So a CT had cost you, for example, they say 10 lakhs. A CT machine cost you 10 lakhs, and MRI machine cost you 20 lakhs. So these are capital investments, 10 lakhs, 20 lakhs. Okay, at the end of the year, you will see how many CTs can be done. Based on that, you can there was a profit of 5 lakhs. Okay, in MRI, you will see how many MRIs were done, and you will calculate a profit of 8 lakhs. Okay, so you will calculate the return, the net profit which you got from 5 lakhs divided by 10 into 100, whatever the answer will be, and then you have to calculate the 8 lakhs divided by 20 into 100 for the MRI machine. Okay, then you will get a answer. If, for example, the return of investment is 10% in CT and return of investment is 12% in MRI, for example. So you can understand MRI machine, investing in an MRI machine was a really good choice than investing on a CT, because the return of investment on MRI machine is a bit higher than CT, but both are profitable. But still, you can retrospect your decision. You can do a retrospection or a retrospective decision analysis or a decision of which investment was better. So that's how return of investment is used in financial statement of an in an institution to compare between different kinds of investments. Then we have profit center. Doctors, for example, doctors, surgeons, marketing team, these are the profit centers within a hospital. So these in standalone basis only, they will bring maximum profit, directly bring maximum profit to the organization. So those are called the profit centers. And these profit centers are responsible for generating their own results and their own earnings. The doctors have their own consulting charges, so it's a direct revenue. Surgeons have their own charges for surgeries. That's a higher revenue. Marketing team will do tie-ups with insurance company and everything. So reimbursement is done on time. They will try to get their hospital empaneled in maximum number of insurance companies, so that will increase the reimbursement as much as possible. So that's a direct profit centers. So this is how a profit center works. They will, in a standalone basis, they create their own revenues and earnings, and they make direct profit. They make direct profit into the institution. Cost centers are the centers which they do not directly add to the profit, but it still costs the organization money to operate. So they only contribute to the company's profitability indirectly. It's not like that they're loss center. They are also profit centers, but they act indirectly, whereas the profit centers will act directly in contributing to the profit. For example, in hospital human resource department, okay, they are not bringing in direct revenue, but they are hiring people who may bring direct revenue to the hospital. Administrative department, they are not bringing direct revenue, but they are taking certain policies, certain decisions on policies, procedures, and standards, which will impact the customer satisfaction and may also impact the profitability. Nursing department, nurses are not paid separately. They are not working on a standalone basis. They are paid only on salary basis. But the nurse-patient satisfaction, nurse-patient relationship will determine the goodwill of the hospital, thus determine the profitability. Research and development department, it is a cost center, but if an innovation is coming through the research and development, it will lead to profits. Okay, so that's few examples of cost centers in a hospital. So investment center is the highest level of management. Profit center are mostly the middle management, and cost center and revenue center will be operational manager or supervision. Nurses and everyone will come under the operational management. So this is how the hierarchy of profit centers and cost centers are within a organization. The topmost is the investment center, the top management. profit centers, direct revenue, then cost centers, indirect revenue. That is a comparison, basis of comparison. Cost center and profit center, meaning cost center is a department of a company to which direct and indirect costs are charged. Profit center is a department or entity which recognizes profit. Objective is cost control and cost reduction for cost center. In profit center, ascertaining the exact profit and maximizing the profit. Evaluation by deducting actual cost from the standard cost, by deducting actual cost from the budgeted cost. Area of operation is quite narrow and area of operation is quite wide in profit center. Role, it is less challenging in cost center. In profit center, the roles are very